If you own a rental on the side of your freelance work, there's a decent chance you're leaving a chunk of the 20% QBI deduction on the table right now. Most freelancer landlords I talk to assume rental income just automatically qualifies for Section 199A because, well, it feels like a business. The data tells a different story. Under Reverend Proc 2019-38, the IRS drew a bright line at 250 hours of rental services per year. Miss it, skip the signed statement, or backfill your logs, and the safe harbor is gone for that tax year. And in 2026, thanks to the One Big Beautiful Bill Act signed July 4, 2025, that deduction is now permanent and more valuable than it's ever been. So the question isn't whether QBI is worth chasing on your rental. It's whether you're actually doing the 4 things the IRS requires to lock it in. Quick framing before we get into the mechanics. I focus on the financial side of freelance and gig work, and rental real estate is the single most confused corner of QBI I see. Freelancers already claim Section 199A on their 1099 income, design work, consulting, delivery gigs, whatever. Then they buy a duplex, or they house hack, or they inherit grandma's condo and rent it out, and they just assume that rental income gets the same 20% haircut. It doesn't. Rental real estate has its own qualification path, and the cleanest, most defensible path is the 250-hour safe harbor under Reverend Proc 2019-38. Everything else is a facts and circumstances argument you'd rather not have with an auditor. Let's talk about what changed for 2026, because this is where the stakes just went up. Before the One Big Beautiful Bill Act, everyone's calling it OBBBA, Section 199A was scheduled to sunset on December 31, 2025. Gone. Zero deduction. OBBBA killed that sunset and made the 20% QBI deduction permanent. Per Reverend Proc 2025-32, the 2026 threshold amounts are $201,750 for single filers and $403,500 for joint filers, with full phase-out at $276,750 single and $553,500 joint. The phase-in ranges got wider too. $75,000 for single, $150,000 for joint, up from $50,000 and $100,000. Translation: the deduction phases out more gradually, so freelancer landlords in that middle income band get more of it. And there's a new floor. Under Section 199AI, if you have at least $1,000 of QBI from an active qualified trade or business you materially participate in, you get a minimum $400 deduction. Small but real. That $400 gets inflation adjusted starting in 2027, rounded to the nearest $5. Your specific number depends on your filing status, your total taxable income, and whether your freelance work is an SSTB. So run your own math, don't take mine. Now the 250-hour rule itself, because this is where people trip. Reverend Proc 2019-38 says, a rental real estate enterprise qualifies as a Section 199A trade or business if 250 or more hours of rental services are performed per year. If your enterprise is less than 4 years old, it's 250 hours every year. If it's older, you need 250 hours in at least 3 of the past 5 years. And here's the part most freelancers get wrong. Those 250 hours do not have to be your hours. Hours performed by employees, agents, and independent contractors all count. That means your property manager's time counts. Your handyman's time counts. The cleaner between tenants counts. Honestly, I think this is the single most misunderstood piece of the whole safe harbor. Freelancers hear 250 hours and picture themselves personally swinging a hammer every weekend. You don't have to. You just have to document it. What actually counts as rental services? Per Section 3.04 of the Revenue Procedure, advertising the unit, negotiating and executing leases, verifying tenant applications, collecting rent, daily operation, maintenance, repair, property management, purchasing materials, and supervising employees and contractors. What doesn't count is where freelancers get burned. Financial or investment management doesn't count. Arranging financing doesn't count. Reviewing your own operating reports doesn't count. planning long-term capital improvements doesn't count. And, this is the one that stings, hours spent traveling to and from the property don't count. I've had freelancers tell me they drive 2 hours each way to check on a rental every month, and they're counting the drive. The IRS says no. That mileage might get you a 72.5 cent per mile deduction under the 2026 standard rate, but it does not get you closer to 250 hours. Different rule, different form, don't mix them. Here's where the safe harbor gets narrower than people expect. It's explicitly not available for 4 situations, and if you're in any of them, don't try to jam yourself into the safe harbor. You'll lose. First, real estate you use as a residence for any part of the year under Section 288D. So if you're renting out a beach place and you personally stayed there 2 weekends last summer, the safe harbor is off the table for that property. Second, triple net leases. This one shocks freelancers who own small commercial units. A triple net lease, where the tenant pays taxes, insurance, and maintenance, sounds like the most business-like rental you can have. It's excluded. Third, self-rentals to a commonly controlled trade or business. Though here's the twist. Self-rentals are automatically deemed a Section 199A trade or business under TREAS. Reg Hardy 9A1B14, so you actually don't need the safe harbor for those. And fourth, real estate that's part of an SSTB. Your particular ownership structure, your lease terms, and how you personally use the property all change which bucket you land in. Read your own lease before you file. The paperwork is where the safe harbor lives or dies, and I want to be blunt with you. There are 4 requirements, and if you miss any one, the safe harbor is gone for that year. 1. Separate books and records for each rental real estate enterprise. 2. At least 250 hours of qualifying rental services per year, tracked in the way we just covered. 3. Contemporaneous records, meaning time reports or logs kept as the services are performed, showing hours, description, dates, and who did the work. And 4. An annual signed statement attached to your return under penalties of perjury, saying you meet the safe harbor requirements. That contemporaneous records rule kicked in for tax years beginning after January 1st, 2020. So, if it's April, you're staring at your 2026 return, and you're trying to reconstruct last year's hours from emails and Venmo receipts, the IRS position is that backfilled logs do not satisfy the safe harbor. My take? If you're not already logging, start logging today, even mid-year. A messy real log beats a beautiful fake one every single time. One more thing on grouping that trips people up. Residential and commercial properties cannot be combined into the same rental real estate enterprise. You have to group similar properties, and once you group, you can't switch year to year unless something significant changes. So, if you own 2 duplexes and a small retail unit, that's potentially 2 separate enterprises, each needing its own 250 hours, its own books, its own signed statement. Which, I'll just say it, is why a lot of freelancer landlords with mixed portfolios end up qualifying on their residential side and skipping the commercial claim entirely. The juice isn't always worth the squeeze on a single small unit. So here's what I'd actually do if you're a freelancer with 1 or 2 rentals on the side. First, decide right now whether you're chasing the safe harbor for 2026. If yes, open a spreadsheet or a simple app today and log every rental service hour going forward. Yours, your handyman's, your property manager's. Second, get your books separated. 1 bank account per enterprise, not commingled with your freelance income. Third, calendar the signed statement. It has to be attached to your return every year, and forgetting it is the single most common way I see freelancers blow this. And fourth, if your rental is currently a triple net lease, or if you're personally using the property, don't try to force the safe harbor. You may still qualify as a Section 162 trade or business under the General Facts and Circumstances test, but that's a conversation with an actual CPA, not a YouTube video. Also, yes, one caveat that matters. If your rental produces a QBI loss, claiming it can actually reduce your overall 20% deduction because the loss offsets your other QBI. So a loss-generating rental isn't automatically a win to elect in. Run the numbers both ways before you sign that statement. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this cleared up the 250-hour rule for you, hit subscribe. I put out one of these every week, all aimed at solo workers who don't have an HR department translating tax law for them. And if there's a specific 1099 or QBI question you want me to dig into, drop it in the comments, and I'll work it into an upcoming video. Next week, I'm walking through how to recalculate your Q3 estimated taxes if your freelance income jumped mid-year, because a good June makes for a scary September if you don't adjust. See you then.